各位观众朋友们，大家好，欢迎收看 JxJ 论坛，由我 Jimmy 马健与我们的好朋友 Jim Noteware 为我们一起讨论这个礼拜的时事。Jim, how are you?
I'm doing fine, Jimmy. Looking forward to the discussion today.
I really like your phone. It's very clear. The pixels are very clear.
Good. Maybe we'll do that from now on.
What kind of phone are you using?
iPhone 8, I think. Maybe a 6.
iPhone is amazing this way, yeah.
Yeah.
No, this is newer than iPhone 6, I'm pretty sure. It's either 8, 9, or above. So, Jim, we've been, the headlines are dominated by inflation fears. Obviously, the market has been in turmoil. If you hold tech stocks, everyone's getting hurt in their 401k, their retirement fund. And of course, Elon Musk with his Twitter purchase. I mean, there is a lot to talk about, and it puts tremendous pressure on everyone, including me and you, especially since we deal with a lot of liquidity, a lot of capital. You were mentioning earlier that you heard you had a meeting and you have some insight. Could you tell our friends on the show now, what is your take, and what did they say at the bank meeting?
Well, as I was saying before we got on, I think there's really only two big worldwide news stories right now. Things like Twitter and maybe even the pandemic, they will take their own place in history. But the big ones, which we have to really worry about in the near-term future, the next year or two, are one, the Russian war with Ukraine and all the implications and fallout from that, including probably mass starvation around the world. Excuse me. And then the other one is inflation and interest rates and what is happening there. And you mentioned the trauma in the stock market. And admittedly, I don't follow the stock market that closely because I'm not invested in it. But it is such both an indicator of what's going on and such a determinant of economic activity that even though I'm not in it, I do watch it, not day to day, but I watch the long trends.
Jim,
and
before we get too far, what you just said is very, very interesting. The average American at a specific age has either IRA, 401k, investment account, all the above, especially somebody as accomplished as you. The fact that you said that you are not in equities at all, zero, that is very interesting. When did you make that choice to not have any exposure?
Well, I'll give you two answers. Some time ago, when I felt the inflationary pressures were going up, the government was manipulating the federal deficit and the monetary base of the country. I figured that the stock market was being filled with hot air, and I couldn't rationalize a lot of the PE ratios and other things going on. That's number one. And number two, since I'm in the real estate business, the most important thing to me is my investments in my own enterprises. And I take the cash that I generate and put it into our own projects, because not only are those returns superior than what we get in the market, except in extraordinary times, but also my own capital is a catalyst to attract other capital. And so no other investors are going to invest with people who don't put a lot of their own money up at risk. And so it's hard for me to attract capital from my projects without being the lead investor myself, and what we call co-investment. And so for both of those reasons, I think it's important. Hello, fella.
This is Uncle Jim. Go. Dylan, I'm taking flight. So what you said is absolutely true.
That is frankly, I have more faith in myself than I do in other things. So
I'm in the business I'm in. I should not agree with you. Okay, that's not good for. It's maybe I'm taking.
Can I go ask his?
Yes, you can. Don't come in. Okay, I'm keeping. I love you. Sorry about that.
Well, you just have a little editing to do.
I mean, every day this is. I don't know why today. I apologize. I can't lock this door. Usually they know. I cannot phantom. Okay, no, I could, especially now that, as you know, that I am the last few months transitioning a little bit late. I wanted to for a while to have the right opportunity to go into real estate also. And you're absolutely right. You always bet on yourself, and any kind of construction or real estate investment, it's always is better when we, as lead or not, we have to put our own equity in order to have, to go in together. And that's the right thing to do. And you know that I've been doing that too. Started a little late, but it's better late than never. We know that since last year, probably in QE, like the third quarter, after summer, we already said, hey, this is fraud. This is ridiculous. There needs to be some kind of correction coming, and we knew that. And even though at that time everyone's pandemic's over, people spend, but we knew all the liquidity being pumped in the market. We know that the Feds are artificially propping up this market. But Jim, not everyone has access to real estate or the know-how inside it. It took many years to get there. And the fact is that you were in the market for a long time, but a lot of successful people I know do get in and out. I mean, you can't really time it, but when you feel right, you get out. You can sit out and do something else because it's cyclical, right? There are times when real estate deals are not the best return when you need to be in the market.
Right. But Jimmy, the real estate, the equity side of the real estate market functions much like the stock market, and the mortgage part of the real estate market functions much like the bond market. They're not quite the same, but they follow the same trends. And we talked a lot about that. And what I was referring to is I went to a program hosted by my bank. It was their national chief economist and their national chief investment officer came. And they gave a presentation in the outlook for the economy and outlook for markets and different business segments, et cetera. And so we engaged in, it was a fairly small group, some of the bank's best customers. And we engaged in some pretty salty debate about what's going on.
Salty?
Yeah.
Disagreement.
Yeah, but that's okay, because out of persuasive argument comes a better resolution, usually.
Yeah, if you can talk to the lender and have a salty conversation, that's always a good thing. Maybe make better terms or voice concerns.
So I'll tell you how it went. I'll tell you how it went if you want. So the economist said we're functioning right now with a very high inflation rate. It went from approximately 7% over the end of 21 to this first quarter to about 8.5%, et cetera. But we think it will moderate a little bit, not come down a lot, but it will moderate to about a 6% rate by the end of this year. And then the chief investment officer said, well, a lot of things are happening here. There's a lot of onshoring where American manufacturers are going to bring back their production from overseas. And another thing that's going on is many of the producers are being able to keep their earnings strong because they now have pricing power. They can increase their prices. Some are not being challenged by pushback from their customers, et cetera, et cetera. So he went on. So I raised my hand and I said, I think you two are talking about very different things. First, economist, you said that you think inflation is going to moderate. But when I listened to the chief investment officer saying why the stock market's going to stay strong, I hear all the things that are driving inflation up. And oh, by the way, the producer price index is still higher than the consumer price index, which tells me that upstream it's even more aggressive than it is downstream. And so I think the future is going to have not only inflation, but higher rates of inflation. And they thought about it, and other people weighed in, and we pretty much agreed that inflation is at least in the 8% range, and probably going to continue to go higher for the foreseeable future. Then they talked about, well, is that going to bring recession? And somebody said, well, you know, the economy's strong, corporate balance sheets are strong, personal balance sheets and liquidity are strong, et cetera. And they asked me, well, Jim, what do you think about that? And I said, well, personal liquidity is strong, but it's weakening as people pay down the surpluses they built up during the pandemic, and they go on vacation and buy the clothes and make the household improvements. Liquidity is going down. And oh, by the way, interest rates have already started to go up, and the credit card companies are saying people are taking on more debt, and they're taking that debt on with stratospheric credit card interest rates. And then I said, okay, so now what do you think is going to happen with interest rates? And they said, well, the Fed's doing this and the Fed's doing that. And I said, they're not doing it nearly aggressive enough. And they said, what do you mean? I said, I think the economy right now feels just like 1976. Oh. And these guys weren't old enough to remember what 1976
Neither am I, but I have to study it. I wasn't old enough that, but I know that scares me because you can compare it to 2008 or 2001, but 76.
So then I said 1976 was pretty much of a boom year coming off the 74 recession. But guess what? 1976 turned into 1979. And guess what happened then? We got Paul Volcker. And the reason Jimmy Carter and then President Reagan reappointed him, why? Because they had to cure inflation. And inflation now is just what it was then. And this is even without the redefinition of quantifying inflation. A lot of the things that were causing inflation back then were taken out of today's index, which means that our index is understating the actual inflation that we're going through. So anyway, I said, Paul Volcker used to teach us then, and the economists are now saying the same thing, that you're never going to get inflation under control unless real interest rates are at least 3% above the rate of inflation. So if you believe the rate of inflation today is 8%, that says prime's got to go to 11. And where's prime now? 5, 4? Admittedly, I don't watch it all that closely, but it's somewhere down there. And so when the Fed says, okay, we raised interest rate, we raised the federal funds rate 25 basis points last month, we're going to raise it 50 basis points, maybe once more before, maybe twice more before the end of the year. That says to me, you're going to only raise it 1.5%. We've got to go up 7, 8, 10% in order to get ahead of inflation. And now talk about the bond market. Okay. All right. And the guy jumped, the chief investment officer said, and the bond market's already lost 9%. And I said, that's because the interest rates went up about this much. What happens when the interest rates go up like this, particularly long rates, right? Just do the math. And I said, watch what happens. This math is inevitable. Absolutely. We are the Titanic right now. We are on a path to hit the iceberg. It's too late to turn. And I don't really mean to be a naysayer here. I'm just saying, hold on tight. We're in for a very bumpy ride. And I hope the economy stays strong. The economy can stay strong and weather inflation, but it's the interest rate cure that is going to cause difficulty. And I'm in the real estate business. I'm watching the housing market very carefully. When mortgage rates jumped way faster than the bond market rates jumped, mortgage rates went from below 4 to 5.5, almost 6 earlier this month. All right, within a span of 4 weeks. That's a big change. And home builders are already talking about declining traffic. And the realtors are saying that the froth is off most of the housing sales across the country. It's, again, the math is inevitable. So we got to be very careful here.
We're numbers people. Okay. I mean,
I'm sorry, what?
I'm a numbers person. So are you. The numbers doesn't lie. No matter what you look at, the numbers never lie. Unless the numbers are manipulated. But these are publicly available data. And the devil is in the details. We've seen this before. We've seen it. It's cyclical. It's inevitable. You're absolutely right. The fact is this. It is actually, for years now, whether it's the White House or the Fed, has kicked this can down the road to let the next generation pay. And now the bill is finally here. And it took a once-in-a-generation pandemic. It took a war, first war in 20 years. It took a unprecedented bull market that lasted for a good decade to get to where we are today. And both of us are not naysayers. Both of us, it's beneficial to us personally for the market to keep going. But the fact is, we're not here to tell people, hey, the sky's falling. Hold on tight. Do the prudent thing. Be responsible. Be accountable. You have I have a fiduciary duty. So do you to people, to our family.
Yeah.
It's free. Greed and fear could get you so far. This is actually healthy. Our market, we need to slow down. We need to par out some of these companies are not supposed to be around, just like in 2008, 2009. And that's how we could grow again. It is not natural to keep growing at this rate. Without even talking about P ratio, without looking at debt, I mean, the numbers don't lie. And Jim, it will hit the real estate market too. We're in a bubble.
It already is.
We're in the height of the bubble. I know that, and you know that. And the sad thing is, we've seen this. That's why we're historical. Everything that's going on, whether it comes to war or international politics, human tragedy or market, or is not like it has all happened before already. We have enough of a database, a history to determine
that. Yeah. So I think, and another confirmation, I talked to one of my daughters today who works for the U.S. operations of a German private equity company, and they issued their own internal economic report earlier today, and their forecast for the next 5 years is global stagnation, or what we used to call in the 70s stagflation. And apparently the disease is moving around the world. In fact, I saw another article today that said the dollar is extremely strong. And what that really means is we're raising interest rates. And in order to, one of the consequences of that is it makes the dollar strong relative to the other currencies. And like Japan, the yen is extremely weak right now, but they're pursuing an expansionary monetary policy.
Weak because I'm sorry.
Go ahead. I'm sorry.
They're extremely weak because of our monetary policy. We're gonna, as Americans, this is a sad thing. Some countries will fail so that we can protect ours. And it is the best time to go to Japan right now because literally you're saving.
My wife said we should go take a vacation over.
This is very expensive, Japan. You're literally saving 30-40%. The last time I was to Japan, I also picked the right time to go because you don't need to skimp when you're saving 30-40% off the bat just by currency exchange. But Japan has been through this. When they were the second largest economy in the 80s, we crushed them by using the same tactic, and Japan never recovered. So we are lucky that everything is traded in dollars. We're lucky that we are the largest economy in the world, and that we are through our unprecedented time. Because looking at snapshot, don't look at just this day, this week, this month, this year. If you look at snapshot, whether it's through decades or centuries, United States of America, we're going through a growth period of peace and solidarity and no major factors that could ruin and the fact that the stock market could grow like this. So we've had a long run, and we will still have a long run because everything has fallen in place. So look at the big snapshot. The market cannot keep going. It cannot keep going like Amazon or Google. It cannot. It cannot. Or Tesla. It cannot. And now this is time for a breather. Now, we're not striking fear. We're not talking about specific positions, by the way. So this will not go against my fiduciary duty. We're talking about overall market. This is personal opinion between me and you. The fact is, you're responsible for your investors, so am I, and for our families. Everybody wants to make the maximum profit at the minimum risk, okay? But a lot of people forget that there are times just by not participating, you're protecting your asset, period, or by moving it to different industries. It's hard for most people to do that. Luckily, we have the option, but it takes time of work, Jim. It takes time of work because you did have a retirement account. You did have a lot of exposure to the market throughout the years, and you've seen your nest egg grow. You know, the number is this. This is the number. If you just keep putting money into an RA or 401k, and the market internal rate of return, the average return is about 7 to 8%, depending on how you calculate. The fact is that is still very attractive without just looking, put it there for 30, 40 years. But what people don't realize is this: there's liquidity events. If you just happen to be lucky retired the year the market's down, how is that going to work? All the projections will not work. Or you started putting money in when the market is all-time high. You know, there's so many factors that you cannot predict, because past performance does not predict future outcome. It never does. No. You have to remember that.
I think what you're doing is making a case, Jimmy, that everyone needs to be responsible for themselves, and they need to pay attention to what's going on around them. And most people have been lulled into a sense of false security or a sense of sleep that, and we've lost sense. It's kind of like maintaining your own physical health. You've got to eat right. You've got to do a certain level of exercising to stay fit, etc. And physical fitness increases your mental fitness as well. You can't get lazy. You have to stay on top of your game, if only to protect yourself.
I absolutely agree. And you know, the sad thing is that majority Americans neither has the time or the intellect or the moxie to want to know, because there's so much misinformation, so much profits being exchanged, so many perspectives where people will not tell you the truth. So many people need this kind of income. How do I say this? They profit from your participation, for everyone's participation in the market. Jim, your video, okay, you're back. So it's very interesting that you're able to share your bank meeting, because that's not everyone's privy to the kind of access. So thank you for sharing. We didn't say the name of the bank nor anybody. You know, this is just general talking. So full disclosure, I have to make sure, because I mean, this is worldwide. Okay, this is streamed to a lot of people, and I always enjoy sharing this with you because you bring a perspective. And like I said, for you to bring on 1976, that immediately perks me up, because 1976 is not like 2001. Or 2008 or the more recent. It is not, and that is what's fearful, because it's also at that time coming out of recession at all time. This is almost to the exact same trajectory to where we're going to be.
Yeah, in my professional life, I've been through 3 major recession/depression: 74 to 76, the late 1980s. Through the early 90s, and then 2007 through 2009 and the after effects. And I'm not talking about the .com /boom that happened in 01. I've let that go out. And then we've had a couple little ripples the last few years. So I don't necessarily think we're going to have a deep recession this time. I think the U.S. economy, the fundamentals are actually quite strong. And I'm actually very happy that wages are going up. My concern is they're not going up as fast as inflation, so people are losing ground. But the workers didn't create the inflation. The political leaders created the inflation. And so everybody loses, including the government. But one of the consequences that will occur is when interest rates go up, the interest payments that the federal government must pay on the outstanding debt, because the debt has mushroomed over the last 5 to 10 years. It's gone up about 50% in the last 5 years. And it's unsustainable at this rate. But if interest rates go up from an average federal rate of 1.5% to 2% to 5 or 6%, that will be, the interest payments will be greater than Social Security. They'll be greater than the Defense Department. And so in order to keep our head above water, we will either have to tax ourselves very heavily to pay that, or we will have to cut out other things, neither of which is going to be at all pleasant for many, many people in the society.
You see, this is why you're not a career politician. You're too truthful. I've never heard someone say we need to tax ourselves heavily. That's just not going to work. I don't care what party you belong to, what ideology you have. Nobody will vote for that.
No,
that's that true.
I remember when President Reagan was running for re-election in 1984 against Walter Mondale, and Walter Mondale made a speech, or he made a comment in their debate, and he said, the only difference, taxes will go up. The only difference is I'm telling you that, and Reagan is denying it. And Reagan looked at him and he says, you just lost.
And absolutely true. That is absolutely true.
Yeah, so I'm making your point.
You got to sugarcoat, the fact is most Americans, we'd rather be blinded we'd rather not see it, like kind of like a ostrich, right? Put your head in the sand and just go blind. It's easier to not worry about things that are out of your control. What people need to realize is that you could control your own fear and greed. You should, you need to be more stable. Don't chase. I advise everyone. It's very hard to do, very easy to say, but very hard to practice. But the fact is, you make these. Mm-hmm.
There's an old adage: when your head's in the sand, a lot's still exposed. You got your big ass up in the air.
Oh, I'm going to steal that one too. I haven't heard that in a long time. But Jim, I appreciate you taking out the time out of your busy schedule. I know you were jam-packed today. Yeah. I know there's so many things going on, but I want to remind everyone throughout these the recessions and corrections you've seen. You're right. This is not 2009. This is not the subprime mortgage crisis. Fundamentally, we do not have the mechanics of something that's absolutely not. How do I say this? It was a hole. There was a problem. That's right, what caused it. This is not it. This is a lot of factors, right? Pandemic and all that. But you make it through all these. When there's opportunity, when there's blood in the street. If you're conservative, if you save and you have the know-how, there's also a good time. I mean, to me, when there's corrections, when there's downturns in real estate, that's when you really make it to the next level. So we'll end our meeting today on this note. I hope next week we have better news to share and more cheerful outcome. And we could probably talk about, we're going to start talking about, maybe do a show about summer vacation plans, or, we talk about your trip to Italy, how fun it was. Maybe we'll talk about a trip to Japan. By the way, I'm an expert.
Maybe we should go to Japan. Yeah.
I'm an expert on Japan. So
good.
Let me know. I've been watching a TV show called Tokyo Vice from Michael Mann on HBO Max, a very excellent TV show about Tokyo. It's about real story.
What's the name of it, Jimmy?
It's called Tokyo Vice.
Tokyo Vice?
Yeah, it's from a book. The writer is a journalist. He's the first American reporter for a Japanese newspaper 25 years ago. He speaks fluently. He's the first one. He was able to expose a lot. As an American, he's able to, great book. And the show was made well by Michael Mann. It also immerses you in Japan. It makes you want to be there, because being the pandemic for 2 years, it is very cool to see something because it was filmed there. And the feeling is like you were there. So if you ever go to Japan, you talk to me, because I plan many trips for people to Japan.
Okay. Well, good. I love it. And Michael Mann was the one who produced Miami Vice.
Yes, he is. That's what's called Tokyo Vice. So he's one of my favorite directors. As a man, as an American man, he is the epitome of gun-ho macho. And he also made Heat. Remember Al Pacino, Robert De Niro?
Yeah.
That's a classic.
Oh, yeah. So, yeah, that was great.
you have very good taste in movies, just like you have in real estate and everything else.
Well, that's why I asked you, because I want to learn another one. So, okay, Jimmy, we'll talk next week.
Thank you.
Bye.
Thank you, guys. Bye.